Here in Canada, there are a number of different tax credits and account types available depending on an individual's personal situation. Two of the lesser-known ones are the Disability Tax Credit and the Registered Disability Savings Plan. They are both relevant to many Canadians who may not think that they are eligible or even know they exist, and present a significant opportunity for those who are eligible. Hi, I'm Lee Bowman from the Andrews Group Asante, and in today's video, I'll be taking you through what the Disability Tax Credit and the Registered Disability Savings Plan are, explaining how they work, and discussing who they may be applicable for. So, who is eligible? Many Canadians with even minor disabilities may be eligible for the Disability Tax Credit. For example, all type 1 diabetics automatically qualify for the credit as of 2021. Other common examples include, but are not limited to, type 2 diabetics depending on their treatment plan, those with autism, vision or hearing impairment, multiple sclerosis, cerebral palsy, mental impairments affecting everyday life, those with mobility issues, and a wide array of other physical impairments. The criteria are not necessarily the condition itself, but how it affects the day-to-day life for the applicant. Form T-2201, available on the CRA's website, provides more detail regarding disabilities that may qualify. If you feel that you may qualify, we recommend having a discussion with your primary health practitioner or specialist. So, what is the Disability Tax Credit? The Disability Tax Credit is a non-refundable tax credit intended to help reduce tax and offset costs incurred by Canadians living with disabilities. The credit is claimable once you have completed an application via CRA Form T-2201, which will include an attestation from your medical practitioner, and have then been subsequently approved by the CRA. It can be claimed by either the person with the disability or a supporting family member such as a spouse, parent, grandparent, or sibling. For tax year 2023, the claimable amount for those 18 and older is $9,428, and for those 17 and younger who receive an additional supplement, the claimable amount is $14,928. In your application with Form T-2201, you will fill out the nature of the disability and how it affects day-to-day life. You can also request that the CRA reassess up to 10 years of previous tax returns, meaning that if you are approved, there could be a significant tax refund awaiting you. This is one of many reasons why it is worth applying if you feel you may qualify. There are many companies out there that will assist you with applications in exchange for a portion of the tax refund that you receive. However, because of the reassessment rule, this could end up costing you a lot of money. Most medical practitioners will be familiar with the paperwork and can assist you with it, though they may charge a nominal fee to do so. Generally speaking, application review and approval can take anywhere from 3 to 6 months, so do be prepared for the process to take some time. Once you or the individual you are applying for are qualified for the Disability Tax Credit, you become eligible to open an RDSP, or a Registered Disability Savings Plan. This is a plan that is designed to help individuals with a disability save their retirement years. It also helps replace income that would have been derived from CPP in retirement. Depending on your family income levels, the government may provide an annual bond paid into the plan retroactively of up to $1,000 per year. They will also provide matching on contributions at up to a 3-to-1 level and will allow you to catch up for previous years that contributions were not made. In practicality, this means you may be able to contribute up to $3,500 in 1 year and receive up to $10,500 in grants. There is a lifetime limit on the bond received of $20,000, and for grants, there's a lifetime limit of $70,000. Once the plan is open, you'll receive an annual mailing of a Statement of Entitlement. This document, usually sent in late February, will detail the amount of money to put into the RDSP to maximize the government grant for that calendar year. Contributions can then be invested so that they grow. You are eligible to contribute to an RDSP up to and including age 59. However, grants and bonds will not be paid into the plan after age 49. Withdrawals from the plan are where things can get complex, but don't let that deter you from the plan, which is an incredibly powerful long-term savings tool for those with disabilities. There are two types of withdrawals: a disability assistance payment, which is a one-time payment from the plan, and a lifetime disability assistance payment, which is an ongoing payment from the plan, similar to a retirement income fund withdrawal. For either type, if you have received government contributions in the last 10 years preceding the withdrawal, you will be required to repay government grants. In other words, there is a full 10-year vesting period from the government's last contribution to your RDSP. There are specific rules that apply to these withdrawals depending on if the RDSP was funded more by government grants or by individual contributions, and so any long-term RDSP withdrawal plan should be well thought out and analyzed in advance. We know these rules and details can be confusing, and we're here to help. I would encourage you or anyone you know who might be able to qualify for these programs to reach out, as it could make a huge difference in their financial lives. While this video focused on the disability tax credit and the registered disability savings plan specifically, there are many other programs available to those with disabilities, such as the Assistive Devices Program, the Home and Vehicle Modification Program, and more. The Government of Canada's website lists these programs and has additional details available. Additionally, there are many disability advocacy groups in Canada that may be able to provide additional guidance depending on the specific disability. Thanks for watching.